Hey, Pete, it's good to see you. We have such an important conversation today. We are talking 4 year-end tax
Mhm.
strategies. I can't believe that the end of the year is just creeping up. We are still firmly in bear market territory. Stocks and bonds are negative, and the market has lost about 16% of its value since the beginning of the year. So, we want to talk about how those negatives, though, offer some unique opportunities. And the first consideration that you have for us is something known as tax loss harvesting. What is that?
Yes, Erin, thank you. Basically, tax loss harvesting is when you sell an investment that's underperforming and losing money. For example, you may have sold a stock or a mutual fund for a $10,000 loss.
Hmm.
You're able to deduct $3,000 a year against those gains until that loss is used up. Or another example, let's say you need to raise some funds. You may sell a stock or a mutual fund for a $10,000 loss, but you can also sell a stock or a bond for a $10,000 gain.
Hmm.
They're going to wipe each other out in that tax year. So there's no tax due. So the tax loss harvesting is part of the income and tax planning that we do each year for our financial clients.
All right, that's such an important consideration. Next on your list, I feel like I hear about this pretty often, is rebalancing. Why is that important?
Yeah, rebalancing each year. From year to year, different asset classes
Hmm.
outperform other asset classes. And for example, if you have a 60-40 stock to bond portfolio, you can see that, the stock market outperforms bonds over time. So your stock portfolio is going to be larger than your bonds. You're going to be on balance. So each year, it's very important that you rebalance your portfolio to your target allocation. This is going to help you stay on track to reach your long-term goals. So each
Okay.
year we try to do that at the end of the
Hmm.
year.
Okay. Now, number three on your list sounds very scary to me. You're calling it Beware Phantom Income. That would be a good Halloween costume, though, but what is this
Yeah.
one?
Yes. Well, basically, as somebody who prepares our clients' taxes and as a financial advisor, I have no problem when my clients are taking a profit to and pay taxes on that money if they're spending that money for
Hmm.
life for income each month or to buy large purchases like a car or vacation. I do have a problem though when people are paying taxes on money that they're not spending. Now, this can happen a few ways. You may have an advisor or a broker who trades the market or tries to time the market. That's creating capital gains on money that you're not spending. Or you may have a managed mutual fund. And with managed mutual funds, in years like this where we see the market selling off, that fund manager has to sell stocks inside of that fund, and those capital gains get distributed to you, even though you're not selling your fund. So you're paying taxes on money you're not spending, and also while your mutual fund is losing value. Now, this is the reason why we use ETFs and
Hmm.
index funds. We're better to control your taxable gains each year using those funds.
Well, that is scary now that you've explained it. Thank you.
Yes,
And
yes.
last on your list, I'm hearing about these a lot this year, Roth conversions.
Yeah, Roth conversions, tax free, right? You got to wrap
Hmm.
your head around being tax free. It's amazing when I ask my clients and potential clients, where do they think taxes are going to be in the future? They all
Up.
say it's higher, never
Yep.
going to be lower, right? And I realize, well, back up a little bit. Right now, historically, we're in a very low and very favorable tax environment.
Right.
And I realize we're human, right? Nobody likes to pay taxes. Roth conversions are like working out. The hardest part is starting. A Roth conversion is paying now for future benefits. Now, I have some clients say, hey, but that's going to put me in the 22 or 24% tax bracket. Well, we have a progressive tax system. You're not paying 22 or 24% on all your taxable income. For example, married couples, you have a $28,000 standard deduction. That's $28,000 of your income that's tax free.
Hmm.
And from your next $20,000 is taxed at 10%. And then from 20 to 83 at 12%, and so on.
Hmm.
So when we convert, it's your real tax rate or your effective tax rate, which is the tax that you pay on the entirety of your income. So you may be in the 22 or 24% tax bracket, but on that conversion, your effective rate and what you're paying on the total of your taxable income is maybe 10, 12, or 14%. So now this is the time. We know that our deficit is going up each year. This is the time to build up some tax free income, and converting is the right way to go, because for my clients, the idea is when they retire to have three distinct tax qualified buckets of investments. You have your tax deferred IRAs and 401ks. All that money is going to be taxable when you take it out.
Right.
You have a Roth IRA, we know that's all tax free. And then you have after tax investments, your non retirement, non qualified accounts. You only pay taxes on gains, and it's taxed at a favorable tax rate. So the more that you can do to plan for your retirement and have those three distinct qualified buckets of money, it's going to give you the opportunity to control your taxes and have more choices in retirement.
Mm-hmm.
And that's really
Well
what
said.
we want, more choices.
Yeah, tax diversification also very important. Well,
Absolutely.
this was really helpful to talk through. Some of these strategies are a little bit more complicated than others. If somebody has questions about what we've talked about, Pete, what's the best way to reach you?
Reach out. My phone always rings. My door is always open. The phone number is 847-499-3342. Or just pick up the phone, call us, schedule a time to come in, and we'll be more than happy to go into detail to your particular situation to see if we can help you.
All right, Pete, thank you very much.
You're welcome, Erin. Thank you.